Hello. Good afternoon, everyone. And thank you for all being here today. I'm Shantala Kumble and I'm the moderator for today's webinar. Conversations about succession are never easy. We often put them aside, thinking there is always more time. But planning ahead isn't just about tomorrow, it's about clarity and peace of mind today. And trust is one of the smartest tools to make this happen. Our session today, titled Building Generational Wealth Through Trusts That Last, is all about legacy, responsibility, and creating a sense of security and harmony for those who will walk the path after us. At IMMPL, we have had the privilege of guiding families through this process. The important question which normally crops up when it comes to estate planning is, what is the right tool that I have to use? Should I do a will? Should I do a trust? Should I do both? Or maybe something else altogether? And I think the answer to this question can only happen through conversations on what the final objective is, on what the family structure is. And we are more than happy to have these conversations and help you firm up the most appropriate tool that meets your objective. Before we begin, a quick note. If you all have faced any challenges, or if you do face during the session any technical issues, please drop in a message in the chat box and we'll see how we can help you. We'll take up the questions at the end, and the Q&A box is available for you to post your questions. And finally, we truly value your feedback. So please do give your feedback, and it helps our further conversations make it more meaningful and useful to you. With that, I'm delighted to hand over to our speaker, Ms. Akshika Harikrishnan. She is a director in the private client and tax practice at Khaitan & Co. She specializes in succession planning, family governance, and structuring, and has advised families across India and overseas on creating seamless wealth transitions and lasting legacies. She will guide us through this important and often overlooked conversation with clarity and care. Over to you, Akshika.
Thank you, Shantala. Thanks for having me. And good evening to everyone. Thanks for joining us this Friday evening. I'm just going to put up my presentation. So the topic today is building generational wealth through trusts. And I'm hoping by the end of the webinar, I'm able to take you all through what essentially a trust is and bust certain misconceptions that several people have around trusts. Before we get into the topic of trust, I wanted to essentially take you all through some of the trends that we are seeing in the succession planning space. We are increasingly seeing that there's a fair bit of foresight and awareness. In fact, a few years back, when we were talking about succession, it used to be a taboo conversation. A lot of them weren't very comfortable talking about succession of assets or even of business. But increasingly more so after the pandemic, we are seeing a fair number of them becoming very open to these conversations because there was a fair bit of unclaimed assets. People don't know what assets are really held by family members. And also it led to a lot of disputes and so on. Also, we are seeing a lot of changes in overseas laws, which is having an impact in India. If you see countries such as US, UK, and several other European countries which have inheritance tax, it affects the assets that is held throughout the world, not necessarily the assets that is held in those countries. So if you take the case of US and UK, they have an inheritance tax of 40% of the market value of the wealth. So for several families which have assets in India, and if they are US citizens and so on, they are looking at planning for this overseas cross-border inheritance tax. Otherwise, in many cases, they would have to sell their assets to really pay this tax. Also, in the recent past, or more so particularly close to every budget, there is a lot of banter around reintroduction of estate duty. As many of you all would know, in India, we did have an estate duty, which got abolished in 1985. And increasingly, we're seeing that with the wealth that is being generated in India, there could be a possibility of reintroducing this tax. So, a lot of families are also wanting to put in structures to see that if at all there is this tax that is reintroduced in India, can you really plan for that in advance? Because if at all they reintroduce inheritance tax and you're looking at planning at that point of time, you really can't do much. Also, we're seeing a fair bit of individuals in India wanting to move overseas. This could be for education, business, or even lifestyle. And conversely, we're seeing a lot of people also coming back to India. And particularly when there's this change of residency, we're seeing a lot of them wanting to look at what sort of implications it will have, both from a tax perspective and also from a foreign exchange regulations perspective. And it's important to plan and do some sort of pre planning before any sort of change in residency because of our foreign exchange regulations, which has a lot of restrictions in terms of being a non resident and having assets or investing into India. Also, we're having a lot of conversations where people are wanting to have some sort of structure for asset protection, be it for business liabilities, creditor claims, for business purposes, if you're giving personal guarantees and so on, then can you really have some structure which will ring fence against any sort of potential liabilities? Even as directors, right, there are a lot of onerous liabilities for directors. And if at all there is some issue, then it affects all of your assets and all your assets are frozen. Marriages made in heaven. Today, that's no more a certainty. And increasingly, families are wanting to plan in case there is any sort of potential separation in the future. And in India, prenup in the true sense doesn't work, which is why families are saying, can we have some sort of ring fence structure if at all there is any sort of potential separation in the future? HUFs, which was once very, very popular, has now lost that sort of shine and popularity. And it was typically set up for tax reasons. But now, if you see, it's really lost that charm. And also, what we're seeing is it's becoming very complex to administer, particularly when you have cross border family members. Like if you see in the case of US, if there is an HUF in India, several families have not really reported the HUF, even if there's no distribution from the HUF. And subsequently, they've had to pay huge interest and penalties for any sort of distribution from HUFs. So increasingly, we're seeing families unwinding HUF structures, partitioning their HUFs, and setting up trust structures. When you look at the succession planning tools, we have several available. And like Shantala mentioned, you really have to find the right fit. And that would really depend on what sort of objectives that you want to achieve. And it's very important to bucket your objectives into the short term, medium term, and the long term. In the short term, a will is an absolute must. If you want to pass on your assets in a desired and a particular manner, it's important to have a will. Otherwise, it essentially goes as per your succession laws, which is essentially the religion that you are born to. The other important tool, which is our focus today, is private trust, which gives you a lot of flexibility in terms of how do you really want to pass on the assets, and also it can be done in a calibrated manner. When several family members and family branches are involved, and particularly when it comes to operating businesses, we've also seen shareholders agreement become very, very important. This would look at inter se rights between various shareholders. How will the family represent on the board? How does the family take decisions? What if a family member wants to exit? All of that gets captured into a shareholders agreement. We've also increasingly been seeing a lot of families saying that if visions are very different and they're not very aligned, they are okay to amicably separate to avoid any sort of potential disputes. In that case, family settlements become very important. And it's important to structure that in a very tax efficient manner because it's more a realignment of assets between the family members. In the long term, we're also seeing a lot of families wanting to set up their own family offices or investment vehicles. This could be when you're looking at building a pool of wealth outside of your business, if there is some sort of monetization event, and essentially if you want to have some sort of investment office. Families are increasingly setting up their family offices, having professionals run those family offices, and also looking at having family offices outside of India. And typically, we've seen popular jurisdictions being Singapore and Dubai. When it comes to larger families with multi generations involved in a business, family charters and constitutions are also becoming very popular to ensure that the family business is perpetuated and also it minimizes disputes. So, essentially, if you're looking at succession holistically, it'll be a combination of all of these tools. So, do you trust the trust? I'm hoping by the end of this session, I will get you all to nod and say yes. So there could be various drivers for really setting up this trust. It could either be business or for personal reasons that you're wanting to set up these structures. Some of the drivers could essentially be if you have minor children, what if you're not around? How do you really protect the interest of the children and ensure that the assets are held for their benefit and it also grows and gets preserved? Also, in several cases where you have people with special needs and you really are concerned about what happens if you're not around, because as long as the parent is around, they take care of the child. But if the parents are not there, in that case, how do you really provide for the child or that person's medical needs, their maintenance, lifestyle, and so on? That becomes very important. Also, ring fencing is increasingly something that a lot of families are wanting to have a ring fence structure for their assets. If you're giving personal guarantees and so on, if those guarantees get invoked, it extends to all of the assets that you hold, which is why increasingly individuals are saying, can we have some sort of ring fence structure? If at all there is any sort of personal guarantee getting invoked, it doesn't really affect that structure and you still have assets for your own lifestyle. Like I mentioned before, prenup trusts are also becoming very popular because a prenup per se doesn't work in India. But if you're able to set up a trust and then structure the trust in a manner that if at all there is a potential separation, the spouse can never claim against those assets that is held in a trust. Cross-border inheritance tax could also be one of the drivers. And increasingly, with families becoming so global, particularly being in the US, UK, and so on, families are wanting to plan against this inheritance tax because the value which they would have really invested in the asset would have been very nominal and it would have grown over a period of time. So, to have 40% of that wealth washed away in taxes is something that they want to ring fence and plan against. Also, in certain cases, like if you look at the Sharia law, there is forced heirship. And certain families also do want to plan for that to say they want to give the assets in a desired manner in the way they would want to. To give an example, in Sharia, if there are only daughters, even extended family members have a right in terms of the wealth. So, particularly when they have daughters, they're saying, I want to give all the assets to my daughters, and is there a way to do it? And trust is one of the solutions that we typically rely on. And the biggest driver for really planning for trust is to avoid any sort of future disputes. So, what really is a trust? If you look at our trust law, it's been there since 1882. And the trust law essentially says the trust is an obligation that is annexed to the ownership of property and arising out of confidence reposed in and accepted by the owner, or declared and accepted by him for the benefit of another, or of another and the owner. So essentially, you have one person who's the settlor, who essentially sets up the trust and they transfer the assets. They transfer the assets to the trustees, who are the legal owners of the trust. And these trustees essentially hold the assets for the benefit of the beneficiaries. So when we're setting up a trust, we typically want to have one settlor. And this person will essentially establish the trust and they'll also transfer the assets into the trust. It's not necessary that you have to transfer all of the assets upfront. It can also be done in a calibrated manner over a period of time, because you'd also want to do this in a very efficient manner. In case of certain assets, there could be stamp duty implications of transferring it into a trust. So usually we transfer assets in a staggered manner, and anything that is left behind in the hands of the individual, the balance of it is bequeathed into the trust to the will. And if you're looking at complete asset protection, we don't want the settler to assume any other role. But honestly, there's no bar in the settler being a trustee as well. And in several cases where families have said, okay, I'm okay to transfer the asset, but I still want to control it, then the settler can also be a trustee of the trust. Now, the trustee, like I mentioned, is essentially the legal owner, and they're holding the asset for the benefit of the beneficiaries. Now, the trustee has complete discretion to take the decisions pertaining to the trust, be it in terms of investment of trust property, buying and selling trust property, making distributions to the beneficiaries. The trustees are essentially like the decision makers, and they act pretty much like the directors. And trustees can either be individuals, or it could be private trustee companies, or there are several professional and institutional trustees also who provide this service as such. The beneficiaries are essentially those who receive the economic benefit from the trust. And typically, when we are setting up these trust structures, we want the settler and beneficiaries to be relatives for it to be tax exempt. And beyond receiving or the benefit from the trust, they typically don't play any other role. You can also clearly define either a pool of beneficiaries to say, let's say if there's a family of 4 and we have the patriarch setting up the trust, we can say it's going to be his family and lineal descendants. In certain families, they've said they want each generation to benefit. Like during the lifetime of the second generation, they want only them to benefit. Then only after that will the third generation essentially get benefits from the trust. So in those cases, you can also layer your beneficiaries to have primary, secondary, and tertiary beneficiaries, and so on. And it's also possible to really segregate in terms of having income beneficiaries and corpus beneficiaries. So the income beneficiaries are entitled to receive only any sort of income from the trust, which the trustee would distribute. But corpus beneficiaries are entitled not only to the income, but they are also entitled to the capital or the corpus of the trust. So what are essentially the benefits of the trust? One is it essentially helps you transition your assets in a smooth manner. You don't really need a will for the assets in the trust. And there's no question of probate. So in one particular case, there was this individual who came and said, if I leave a will, I don't want to leave the hassle to my children to go about executing that will. So if you create the trust today, then you're able to transfer your assets today, build in that sort of governance today. So there's really no question of having a will, and succession becomes automatic in that sense. Also, it enables you to have a very strong governance mechanism. So in certain cases, families are saying they want to have certain restrictions in terms of who can really be the beneficiaries. When should really distributions be made? Maybe in certain cases, they don't want to be investing in certain assets. So all of that governance can essentially be built into a trust. And it also gives a lot of financial stability to the beneficiaries without actually having the absolute ownership. So essentially, they have the economic ownership, the trustees have the legal ownership, and they hold it for the benefit of the beneficiaries. It also gives asset protection, like I mentioned, in terms of creditor protection, any sort of matrimonial disharmony, even in terms of any reintroduction of estate duty. We don't know the form and manner in which it will really be introduced, but at least you have a structure in place and you can make tweaks to that structure, which will hopefully ring fence against any sort of inheritance tax. It also gives a lot of settlers the right to retain the control. And that is something which is very, very important to a fair number of them, where they're saying, okay, the asset can benefit my spouse and children, but I still want to control the decisions in terms of those assets. And that is possible only through a trust structure. Also, since trust minimizes any sort of disputes, the role of courts become very, very limited. In a trust deed, if there is any sort of dispute, you also clearly lay out in terms of a dispute resolution mechanism and how disputes will really be resolved. And also, because you're able to build out the governance and clearly lay out in terms of who will be the trustees, who are successor trustees, how decisions will be taken, how distributions are made. So chances of potential disputes is minimized to an extent. It also gives you a lot of flexibility in terms of how you want to make distributions. So in certain families, they've said, okay, when I have my child attain 18 years, I may want to give a lump sum amount. If they're 21 or 25, you can actually stagger out and build in restrictions and also enable distributions based on specific needs. If you have in terms of any incapacitated beneficiary, you can also clearly lay out that without having approval of any person, you will discharge any sort of medical bills, their maintenance, and so on. So at least their interests and needs are protected. Lastly, the trust is very easy to set up and the maintenance cost is very, very minimal because as soon as you execute the trust deed, the trust is set up. And only if the trust has immovable property is there a need to really register the trust. Otherwise, beyond that, you have to just apply for PAN, open a bank account, DPAT account, and you're good to go. Every year you have to file a tax return. So essentially, it's another tax file that you're creating. So moving into the taxation of trust, the taxation really depends on the type of trusts. And the type of trust is further segregated based on control and based on the identity or the share of beneficiaries. Now, based on control, you either have a revocable or an irrevocable trust. A revocable trust is essentially where, when the settler sets up the trust, he has the right to revoke and take the assets back from the trust. That would make it a revocable trust. Irrevocable trust is when you essentially set up the trust, transfer the asset, but the settler doesn't have the right to take that asset back. It is essentially held for the benefit of the beneficiaries. Now, also we have specific or determinate trust and discretionary trust. A specific trust is essentially where the share of the beneficiary is very clearly defined. So if you have 3 beneficiaries in a trust, you will clearly lay out to say each beneficiary has 1/3 share. That would make the trust specific in nature. But if you leave it ambiguous and you don't really attribute a share to the beneficiary, and essentially the trustee decides in terms of what is the quantum and timing of distribution, then it's a discretionary trust. So usually when we set up trust structures, we prefer the trust to be irrevocable and discretionary, in the sense that once the settler sets up the trust, they cannot take it back. And we also want to keep the trust discretionary without specifying the share of each beneficiary, because it provides for asset protection, it provides for that sort of ring fencing. And also in terms of inheritance tax planning and so on, we prefer to keep it discretionary and not attribute any share as such. So here is a very typical trust structure. Obviously, it's based on facts and circumstances and what objectives one would want to achieve. But typically what we suggest is have separate trusts for your business holdings and for your personal holdings. Because if you want to ring fence assets, it's better to segregate both. And then you essentially have a settler who sets up these trusts. We would typically want to have one settler rather than multiple settlers. So in that case, we do some level of pre-gifting amongst family members to consolidate all the assets with one individual who essentially sets up the trust. Now, the settler, when they set up the trust, they will transfer the operating businesses into the business trust and all the personal holdings into the family trust. And when we have listed companies and so on, we typically suggest have separate trust structures for each, because once the company gets listed, it's under the rigor of SEBI. So we try to keep that separate. And the beneficiaries of the trust would essentially be the family members. The trustee also, you have the flexibility in terms of choosing who the trustees will be. So when the settler sets up the trust and transfers the asset, they will essentially gift it into the trust. When you transfer the asset into the trust by way of gift, there is no capital gains tax implications at that point. Also, if the trust is set up such that the settlor and beneficiaries are relatives, then there is no tax even in the hands of the trust. So, relatives is very clearly defined in our tax law, and it includes lineal ascendants, descendants, siblings, and so on. The unique thing over here is if someone's wanting to set up a trust where it's for their sibling as well as nephews and nieces, nieces, for the purpose of this particular clause, is not relatives, but siblings is okay. So we have to really ensure that it is compliant from a tax perspective, so there is no sort of tax leakages as such. And when you're transferring assets into the trust, there are also stamp duty implications that you'll have to bear in mind. So you'll also have to evaluate that in terms of what assets you want to be transferring into the trust today, vis-a-vis at a later point of time. Now, when the trust is revocable, then it's really not a transfer from a tax perspective. So if there is any income in the hands of the trust, it is going to continue to be taxed in the hands of the settlor. But because we set up the trust as an irrevocable trust, the trust itself will pay the tax. And the tax is paid typically by the trustee as a representative assessee. And again, the rate of tax would really depend on whether the trust is discretionary or a specific trust. In a specific trust, it essentially goes back to what is the rate applicable to each of the beneficiaries. But in a discretionary trust, the trust gets taxed at maximum marginal rate. When I say maximum marginal rate, if it's any sort of income in the nature of dividends, interest, rentals, that essentially gets taxed at 30% plus your surcharge and cess. Here you don't get the benefit of slab rates. And if it's capital gain, then it's essentially 12.5% plus your surcharge and cess. And once the trust pays tax, any subsequent distribution to a beneficiary, there is no additional tax. So really, there's no question of double taxation. There's tax only at one level. Now, at some point of time, if you want to dissolve the trust and distribute the assets to the beneficiaries, at that point of time also, this is tax neutral. When the assets are distributed from the trust to the beneficiaries, there's no additional tax as such. So here I just wanted to give you all an overview of a will versus a trust. And I really don't want to delve into what a will is. I'm assuming that all of you all are aware what a will is. So with a will, you're able to have complete control of the asset during your lifetime. But in a trust, you essentially transfer the assets into the trust. As a trustee, you can have some level of indirect control, but we really don't want the settlor to ever be a beneficiary in the trust. Because if the settlor becomes a beneficiary in the trust could be treated as revocable, and I really don't get any sort of asset protection if I'm still going to benefit from the trust. In a will, there is no level of asset protection because you continue to hold the asset in your own individual name. But in a trust, if I structure it in the right manner, I'm able to get asset protection from any sort of personal guarantees, from any sort of liabilities, any potential marital separation, and so on. Now, the will, when it comes to the implementation of it, there is always a possibility that the will could be challenged. And in certain cases, there could also be a need for a probate of a will, which is a very, very cumbersome process. But in a trust, because you're setting up the trust today, you're executing a trust deed today, transferring the assets today, the implementation becomes a lot more seamless in that sense. In case of both will and trust, confidentiality is maintained to a very large extent. The only thing in a trust is when you're applying for your PAN, your bank accounts, and so on, then obviously you'll have to give a copy of the trust deed. But otherwise, typically, it's a very confidential document. Now, when it comes to applicability of personal laws, with a will, there is a level of involvement of your personal or regional laws that will apply. But in a trust, really, personal laws doesn't apply. Whatever are your wishes, that can essentially be built into the trust and the assets can be transferred into the trust. And when it comes to documentation for the trust, like I said, it's just the trust deed. And if at all there's immovable property, you will have to get it registered. Now, when it comes to tax and stamp duty implications, any assets that's bequeathed under a will, there is absolutely no tax implications and there's no stamp duty as well. But in a trust, you will have to consider the stamp duty implications. And if you structure the trust in a right manner, there's absolutely no tax as well. So here we wanted to take you through some case studies to also make it a lot more relevant in terms of how people are really using trusts for either their business or personal needs. So the first case study is essentially where we had an individual who is a first generation business owner and he's retired from the business. Now, his son is currently managing the business and he is married to Mrs. C and they have two children, D and E. D and E both are again involved in the business. D is essentially involved on the manufacturing side of the business and E is essentially involved in the specialty foods division. Mr. D is married, he has two children. Mr. E is divorced and he has one child. And beyond the business holdings, the family also has several personal holdings. The objective for this family was essentially protection from any sort of potential estate duty in India. They also wanted to ensure that there is clear segregation of control and benefit. Now, for Mrs. C, they also wanted to protect her interest if at all Mr. B passes away. And because Mr. E is divorced, we also wanted to have some level of asset protection for him. So here, essentially what we did is we set up two separate trusts where we had a business holding trust and we had a personal holding trust. And we had Mr. A, who's the first generation founder, set up this trust. Once he set up the trust, he did not have any other role. He is not a trustee, nor was he a beneficiary. Now, in the business and the personal holdings trust, the beneficiaries were essentially the second generation, which is Mr. B and Mrs. C. And also we had two trusts for their children because we wanted to make it absolutely clear in terms of what is the share of the children and we didn't want any sort of ambiguity. So during the lifetime of Mr. B and Mrs. C, the trusts were discretionary. But post their lifetime, we said the beneficiaries are going to be equal and D trust and E trust will essentially have 50% interest in the business holding trust and the personal holding trust. And the sub-trusts, which is basically trust D and E, were discretionary in nature. When it came to the trustees, during the lifetime of Mr. B, he wanted complete control. So he was the trustee of the business and the personal holdings trust. And also we clearly defined in terms of who will be the successor trustees. Here, successor trustees were essentially their children, Mr. D and E, who would jointly take decisions. But also we built in a sort of decision matrix because each of them was running their own business vertical. So we didn't want any sort of deadlock when it came to taking decisions for the respective businesses they were running. So we actually carved out a decision matrix to say what are the critical matters and what routine matters and what is the level of power they will have in each of their businesses. Anything which was strategic or absolutely critical for the family, then both of them had to take decisions together. And also what we did was we also built in clauses to say that if at all anyone wanted to exit the business, how exactly the exit would happen. You would essentially offer it to the other brother. And then if the other brother is not able to purchase it, then possibly you could bring in a third party and so on. So we also built in those sort of right of first refusal and so on. When it came to protecting the interest of Mrs. C, what we said is we will have a letter of wishes in terms of how distributions should happen. A letter of wishes is essentially a letter that the settlor gives the trustees, which is a non-binding document, and says that these are my wishes with respect to the trust when it comes to the distribution. And typically what we've seen is trustees honor the letter of wishes that the settlor gives. And also to reduce any sort of ambiguity, we also had very specific distributions to Mrs. C after the lifetime of Mr. B, because we wanted to ensure that her lifestyle, her maintenance is taken care of. So there was a specified amount that was distributed from the trust to her post Mr. B's demise. And also, when it came to Mr. E's protection, we built in a fair bit of spousal restriction clause. So we actually defined who will be the beneficiary pool, in what cases spouses can be beneficiaries. If at all there is any sort of potential separation, if there is a divorce and so on, then the spouse will not have any sort of role in the trust and they'll automatically be removed either as a beneficiary, trustee, and so on. The other thing that we also did consider, particularly because of the third generation and minor children, we did have the concept of a protector. So, a protector is essentially a person who ensures that the wishes of the settler is enforced by the trustees. So, in terms of certain decisions, we actually said that the trustees will go and get a guidance from the protector, and based on that guidance, they will essentially implement those decisions. So essentially, a protector is like a guardian angel who ensures that all the beneficiaries' interests are protected. And also because in this particular case, there were active businesses being run, and at some point of time, even the third generation would join the business and so on. We did have a family constitution. Now, the second case study is essentially how we safeguarded the interest of a minor in a particular case. So we had Mr. and Mrs. A, who are first generation business owners, and they essentially wanted to set up a trust for their grandchild, Master C, who was a minor. And the child's mother, Miss D, was divorced, and she has the sole custody and guardianship of the child. Now, Miss D's succession planning was undertaken separately. Here, essentially, what the founder and his spouse wanted to do, they wanted to set up a separate trust for the benefit of their grandchild as such. So, here in this particular case, what we did, we had Mrs. B act as the trustee of the trust. So, during her lifetime, she had absolute discretion in terms of making distributions to this child. It could have been for education, it could have been for medical, and so on. But complete discretion was given to Mrs. B. In case Mrs. B passes away, then we said the mother, which is Miss D, will essentially be the trustee if the child is not of a particular age. So here we had a threshold of about 30 years. So we said the mother will continue to be the trustee till the child becomes 30 years of age. And then we said in that period, when the mother is a trustee, okay, she will not be able to take complete decisions with respect to the trust because we also wanted to protect the asset and we also wanted it to grow in a manner that we are able to make distributions to this child at regular intervals. So we also limited in terms of what distribution power the daughter had with respect to that particular trust. And we restricted it to education, medical, any certain milestones in terms of birthday, graduation, and so on. Now, because there was only one beneficiary, which is the minor child, we wanted to keep the discretionary element in the trust, which is why we also added Miss D, which is the mother, as the beneficiary in the trust. So we have at least two beneficiaries to keep the discretionary nature of the trust. Otherwise, if you have one beneficiary, really, it's very clear that it's a specific trust in that sense. And then what we also did is we said that Miss D will automatically step down as and when Master C has children. So when Master C has children, they automatically become beneficiaries. So Miss D would have stepped down. Now the third situation is something we're finding it increasingly common amongst family, where you have at least one family member either in the US or UK. And this particular instances where there was a family comprising of four, where there's the father, mother, and the son is a US citizen. Everyone else in the family are Indian citizens and residents. Now, because Mr. B is a US citizen, we wanted to undertake some sort of inheritance tax planning because in terms of the assets Mr. B will get through the father as well as what he was building could have breached the inheritance tax threshold in the US. So Also, the other important factor over here was Mr. B is currently separated from his spouse and they're going through a separation and they have a minor daughter. So one of the important objectives was how do we also protect the interest of the daughter here. So here essentially what we did is we had the patriarch Mr. A set up a trust, and the beneficiaries of the trust was Mr. B, who's a US citizen, Mr. B's daughter, who's the minor, and also we had Mr. B's sister as a trustee. Okay, so we essentially had the children, the second generation, as well as the third generation as beneficiaries, and this trust was set up as a discretionary trust. Now, from a US perspective, such a trust structure is treated as a US foreign non-grantor trust. Okay, and there are certain implications in the US of setting up such a structure. Maybe I can just give you a quick overview of what those implications are. So if the trust is a non-grantor trust, which is essentially irrevocable trust and has beneficiaries beyond the settlor and his spouse, then if at all there is any sort of income at the trust level, US expects you to distribute it year on year. If you don't distribute it year on year and you accumulate it in the trust and you distribute it, let's say maybe 5 years after, then US says that ideally a US beneficiary should have received the trust income every year. Because you've accumulated it and not distributed, there is a throwback tax where you pay interest and penalties. Also, if there are active businesses, right, there are control foreign corporation implications. If you're investing in mutual funds and so on, that is also taxed at a very high rate in the US. So in this particular trust, what we did is we invested in growth assets. And in terms of any sort of income that gets generated at the trust level, to avoid any sort of throwback tax, we said year on year, we will either distribute it, okay, and even if we accumulate it, when we subsequently distribute, we will make sure we distribute it to a non-US person and clean the trust of any accumulated income. Also, what we did is, because this trust was set up for the benefit of the US citizen as well as his daughter, okay, and his sister was the trustee, we still wanted to ensure that the sister will take decisions in line with some sort of guidance from this US citizen. So we actually had Mr. B step in as a protector of the trust, and we really carved out in terms of what are the key decisions in terms of distribution to beneficiary, amendment of the trust, investing in trust property, and so on. And we said that all of these decisions, before the trustee takes a decision, they have to go to the protector and get a guidance. Based on the guidance, then ultimately they will take a decision. So also we were able to indirectly have Mr. B exercise some influence in the trust. When it came to successor trustees, we didn't want Mr. B to be a trustee because in the US, if you're a US citizen, being a trustee and a beneficiary, okay, then the decisions you can take is very, very limited. So we said as long as the sister is there, she is an independent person, at least for the purpose of this trust, she will take all of the decisions. After that, if the sister is not there, if the daughter is of a particular age, she can step in as trustee. But if she is still very young, we said we will have a professional trustee. And Mr. B will continue as a protector as such. And in terms of whatever investments that Mr. B was making, we are routing it through the trust. Essentially, the trust will become the shareholder of these assets. And even in terms of whatever assets he's getting through the will from his father, it will be bequeathed into the trust. So here I just wanted to touch upon some of the typical questions that we get and misconceptions people have about trusts. One is people say, okay, I just lose control of my assets and the trust property belongs to the trustees. But honestly, in a trust, a trustee plays a fiduciary role and they are holding the asset for the benefit of the beneficiaries. You can either be a trustee and control the asset, or as a protector, you can still influence that sort of decision making. And if at all the trustee is not acting in line with the trustee, then always you have to have the right to remove a trustee. So really there's no loss of control as such. The other question we keep getting asked is, can a settlor be a trustee and a beneficiary? There is absolutely no bar in a settlor being a trustee and a beneficiary, but the only restriction is the settlor cannot be the sole beneficiary. And also, we don't prefer the settlor to be a beneficiary because of asset protection, the trust being treated revocable, and so on. And the trustee and the beneficiary overlap is also okay. Any beneficiary can be a trustee of the trust. The other question we're commonly asked is, the trust, is it like a static document? Can I amend it? What happens to the property in the trust if it becomes irrevocable? I can't take the assets back. So when I say irrevocable, like I mentioned before, it's in the context of the settlor. But if at all the trust is really not working out, then you can always dissolve the trust and distribute the trust assets even to the beneficiary. So in that case, it is still for the benefit of your family as such. The other thing people say is, okay, what is the sort of minimum net worth I should really have when it comes to trusts? And honestly, it really depends on what objectives that you want to achieve, right? There is really no minimum asset size. If you want to have asset protection, if you're looking at protecting minors' interests, if you're looking at incapacity planning, for all of these reasons, trusts work very, very well. And the other concern we have from a lot of people is it's just very complex and it's too difficult to manage the trust. But honestly, it's very simple. It's essentially another tax file that you're maintaining. And whatever investments you were doing individually, now you're just routing it through a trust. So very quickly, I also want to touch upon some of the current trends in terms of trusts. Shantala, I hope we have a few more minutes.
Yes, Akshika, you can.
Perfect.
Do this, yeah.
So increasingly, we are seeing families say that they want to set up these trust structures today and transfer the assets in a calibrated manner to the next generation. They don't want to wait till they pass away to pass on the assets, because they also want their next generation to start taking decisions in a staggered manner. And that can really be achieved through the trusts. We are also seeing families set up multiple layers of trusts when there are several family members involved. Like in the first case study with two siblings, we actually had one master trust and two sub-trusts, right? So it makes it absolutely clear between family branches in terms of what their stake is. And within a family branch, we keep it discretionary, so they have the discretion of how they want to leave the asset. And from an asset protection point, we're also seeing that we're segregating the role of settlor, trustee, and beneficiary. We don't want the same person to play all of the three roles. We're also setting up a fair number of cleanup trusts. We're also setting up a lot of reciprocal trusts. When I say reciprocal trusts, it's essentially that when a person is setting up a trust, we don't want them to be a beneficiary. So if you have a husband and wife and two children, if the husband is setting up a trust for the wife and children, he also needs certain assets to benefit from. So we set up a reciprocal or a mirror trust where essentially the wife will set up a trust for the benefit of husband and children. So the husband can also benefit from the assets. We are also increasingly seeing, rather than having individual trustees, families are also opting for having private trustee companies or LLPs, or maybe even using professional trustees as such. And particularly with NRI beneficiaries, and where you have to really manage the US UK inheritance tax limit, the trust is absolutely a no-brainer, and that's something one should definitely consider. And with several trusts now, we are also having protectors to ensure that the beneficiaries' interests are protected. So when you're looking at setting up a trust structure, I think the key and the heart of everything is the objectives that you want to achieve. Depending on the objectives that you want to achieve, then we can really structure the trust in a manner that will achieve those objectives. And it's also important to have advisors who will be able to navigate the various implications, because we have a gamut of implications that we have to navigate. It could be personal succession laws, you have your trust law. If there are companies, LLPs, you have the respective laws, you have real estate. If there are non-resident beneficiaries, you have foreign exchange regulations, tax, and so on. And you need someone to look at it holistically to ensure that there are no sort of adverse implications. And it's also important to tie in your objectives and then select the right tool. It could either be a trust, it could be a combination of a trust and will. If you have businesses, it could be either your shareholders agreement, family constitution, and so on. And it's also very important to anticipate. You don't look at only the current situation. You have to also look at what is the possibility and the future, try and anticipate it and then implement it. And lastly, you have to periodically check in. You have to see if facts have changed, circumstances have changed. You will have to have that flexibility to amend your succession. So to conclude, I just want to say there's no one size fits all. It really depends on what you want to achieve and what makes sense for each of you all as a family. And when we're looking at setting up these structures, the 4 pillars that we have to consider is keep it simple, have absolute clarity, keep it flexible. And if at all it's not working out, you have to give the flexibility to unwind. And your focus should essentially be ease of succession rather than focusing on tax efficiency. I want to just conclude in the words of Benjamin Franklin to say that if you fail to plan, you are planning to fail. I'm happy to take any questions that you'll have now.
Thanks, Akshika. It was quite insightful. Before we get down to Q&A, can we just share a feedback form here? And would request all of you to fill the feedback form, and then we'll move on to the questions. Yes, we'll move to the questions now. The first question is, many of these options seem applicable for business owners only. Which of these are relevant for salaried employees?
See, when it comes to business, we're talking about more business succession, where family constitution and so on is relevant, and the family constitution aspect gets built into a trust. But if it's professionals and other individuals, then trust will still be relevant if you're wanting to have some sort of seamless succession, if you're wanting to protect the interests of your minor children, or you essentially want to have one pooling vehicle where you have all of your assets held there and it's for the benefit of your family. So it's not necessarily only for business owners, but we set up trusts for several CXOs and other individuals as well.
Okay, Akshika, and also to avoid probate, the multiple properties in.
Correct. So at least in Karnataka, we have the benefit of doing a settlement of asset into the trust with nominal stamp duty. But if you have assets in other states, or particularly if you have assets in Mumbai, Chennai, Calcutta, there is a need for a probate. And also what we're seeing increasingly is that the value of assets is very high, irrespective of these 3 cities, they're still insisting on a probate. So trust effectively helps you do an automatic transfer. There's no question of having a will and there's no need for a probate as well. So succession becomes automatic in a sense.
Correct. But would you recommend moving the properties to a trust, or that can be done through the will to avoid stamp duty? What would you suggest?
See, we are, in at least if you have assets in Karnataka, we are still doing, in certain cases, we are settling the asset into the trust. But it's really very nuanced and you need to get the right advice of how to really structure that. And in many cases, we are saying that let's move all the movable and financial assets into the trust today. And you will need to hold some assets in your individual name. If you're going to take a bank loan and so on, you still need a personal net worth, right? So in those cases, we say keep maybe your residential home or something in your individual homes, and through the will you can bequeath it into the trust. And at that point of time, it's very clear that there's no tax or stamp duty.
Right. Move to the next question. Can your house where you reside be put under a trust?
Absolutely. In many cases, you have the house held by a trust, and it's very clear that the beneficiaries can also stay in that house, use that house. So it's not an issue at all.
What are the fixed and recurring costs of setting up and maintaining a trust?
So the fixed cost is essentially your initial setup cost, right? You'll have certain advisors that you'll have to bring on board to essentially draft your trust document and set it up. And otherwise, in terms of recurring cost, it's really not much as long as you all are trustees. If individual family members are trustees, there's really no trusteeship fee as well payable, right? You all are managing your own assets. If you bring in a professional trustee, there is a professional trustee fee that they charge, and it's not very significant. We've been able to work with several professional trustees where they charge a fixed lump sum on an annual basis.
Okay. We have a scenario here given by an attendant. Parents who are the trustees set up a trust for their children, who are the two kids in this case, with mutual funds as underlying. And say the parents pass away and the kids are still minors. How does the trust manage these assets held under the trust? That's the
See,
first.
it's very important when you have minor children to think about who will be the successor trustees, right? And you may either have someone who's very close, who you can think will step into that sort of guardian or trusteeship role. You can have that person step into the trustee role, or you can also have a professional trustee, and then you can have like a very trusted person play the role of a protector. So that becomes very important. And particularly with minors, you also have to put in certain restrictions to say that the trustee shouldn't have complete discretionary power, right? They shouldn't be able to sell the asset completely. You put certain restrictions. They shouldn't be able to pledge all of the trust property. They shouldn't. We also put restrictions in terms of what distributions can be made. We put in restrictions to say the beneficiaries can never be changed because it's for your children's benefit, right? You don't want some person to step in as a trustee and change beneficiaries and add assets. So you have to build in a lot of checks and balances to protect the interest of your child.
There's a follow-up for the same scenario. Is there a team of experts managing these assets? Mutual funds in this case is the first question. The second question is, can the trustees have an option to select this team of experts at the start of setting up the trust?
See, when you're setting up the trust, there are a few decisions you'll have to take. Whether you want to have an individual family member itself as a trustee, do you yourself want to play the role of a trustee, or do you want to have a professional trustee? And typically, most of us have investment advisors like you, right? So the investment advisor will also advise the trust. Okay, so that's essentially the team that you need to keep the trust operational. And then you'll have your CA who's filing your tax return. On an annual basis, he will file a return even for the trust. It's as simple as that.
How dynamic are changes in laws with respect to the trusts?
See, the trust law was drafted in 1882. Honestly, there haven't been too much changes in that. And it gives you so much flexibility because it's written in very few words. So whatever are your wishes, we are able to build it into the trust as such.
I'm transferring my assets and I'm not the beneficiary. How in my lifetime will I run my expenses? Because this corpus in itself will be huge.
Correct. So like I mentioned, there are two ways of doing it. You set up the trust, you transfer a portion of your assets into the trust where your family will be beneficiaries. You continue to hold some portion of it for your own lifestyle and needs. The second way of doing it is where we set up two trusts, where husband sets up a trust for the benefit of wife and children. Wife will set up a trust for the benefit of husband and children. So before we transfer assets, we do some sort of realignment between the husband and wife. We gift the assets such that both of them hold equal assets. And then you set up your respective trusts. So the husband can also benefit from the wife's trust.
Right. I have a question, Akshika. See, I agree with you when you say not all marriages are made in heaven. And you also spoke about prenup agreements, family settlements, etc. So, are these done via trust or are they separate prenup agreements? Because I know in the US it's common. In India, I don't know how legal it is to have a prenup agreement and family settlement. How legal are they?
See, prenup in the true sense doesn't work in India. So if you're talking about custody or talking about separation and so on, it's essentially the court's prerogative to essentially decide on those matters. You
Right.
cannot have an agreement to say what will happen in terms of child custody, what happens in terms of your marital home, and so on, which is why prenups don't work. What we have been doing in certain cases is we've been doing marital agreements, which is like a contract, which says that these are my assets before marriage, these are our joint assets. If there is a separation, this is how we will segregate our assets. We
Right.
really don't know how the courts will interpret it. A foolproof way of doing it is through trusts, where you're able to transfer the asset, clearly define who the beneficiaries are. You put in clauses to say if at all there is any separation, no spouse can come and claim against this trust. So the trust itself acts as a prenup.
Right. And is it the same with the family settlement arrangements as well?
See,
Or are they more legal?
family settlement arrangement is essentially a situation where you don't want to stay together as a family, you want to distribute the assets, right? And that document will essentially lay out in terms of how you're distributing these assets. Once it goes to each individual, again, they have to plan for it.
Right. Okay. Okay. There's a question. The Karnataka State Chartered Accountant Association in September 2023 formally requested the MCA to clarify whether Indian trusts not registered under SEBI could be admitted as partners through their trustees, either individuals or corporate bodies. Are you aware of any of the formal outcome of this
See, there's
arrangement?
been nothing. I'll tell you the context of it. Okay, so under the Limited Liability Partnership Act, right, only an individual or a body corporate can be a partner. Okay. Now, the MCA has taken a view saying that only in case of SEBI registered trusts and AIFs, okay, can a trust be a partner in an LLP. Okay, so certain advisors, they take the view to say that the trust is really not an individual or a body corporate. So the trust cannot become a partner in an LLP. Correct? But the trust itself is not a separate legal entity. Any asset that the trust holds, it's always the trustee who holds the asset on behalf of the trust. So as long as the trustee is an individual or a body corporate, the trustee can always hold partnership interest in an LLP on behalf of the trust.
Okay. How difficult is it to get a property bequeathed to a trust settled in a trust post lifetime of a testator? Do we need probate of this will?
See, if it's through a will, it can be bequeathed into a trust. Probate is not mandatory unless you have assets or you're living in Chennai, Kolkata, or Mumbai. But if the value of the assets is significantly large, we've seen even certain other cities and states insisting on a probate. So if you are bequeathing assets in each of these cities into a trust, you'll still have to go through the probate process.
Yeah, but what is significantly large can be subjective. So,
Absolutely. We are increasingly seeing if the value of the property is very large, then sub-registrars are saying get a probate done. But it's honestly in Bangalore and Karnataka, probate is not mandatory.
okay. Liquid assets like mutual fund and equity portfolio, can they also be transferred?
See, with mutual funds, it's very technical. It depends on your mutual fund house, right? So in several cases, the easier way of doing it is you contribute funds into the trust, okay, and then the trust will invest in mutual funds. So in some cases, what we're doing currently is where they're holding mutual funds, we're liquidating the mutual fund, transferring it into the trust, the monies, and then the trust will replicate those investments again. We just have to ensure that it's long term and we get the long term benefit, and you've held that asset for 12 months before selling.
But somewhere in your presentation, Akshika, you said there's no capital gains implication for the transferor. So how does it impact? When you liquidate, there will still be a capital gains implication.
There will be a capital gains, but you transfer the money into the trust and reinvest in the trust. See, when I said there's no capital gains, when you directly gift asset into the trust, there is no capital gains.
Okay.
Here, I'm not gifting it. I'm selling the asset and then I'm gifting the money into the trust.
So I will still have the impact of capital
Correct, but it
gains as an
still depends
individual.
on your mutual funds houses. Some of them permit gifting, some of them don't. They have restrictions. So it really, we have to look at it on a case-to-case basis.
How do you structure shares of listed company in a trust? Has SEBI approval been easy? Can a professional trustee be appointed in such trusts?
So I'm assuming here you're looking at in the context of a promoter or promoter family wanting to transfer shares of a listed company into a trust. So if the transfer is done post-listing, then you have to make an application to SEBI and you have to get an exemption from SEBI. Now, SEBI has clearly laid out saying how the trust can be structured. They don't like professional trustees. They don't like these multiple layers of trusts. They want only promoter group and their relatives to be trustees in the trust. And beneficiaries also, they want only individuals. So there are lots of restrictions post-listing if you have to transfer promoter shares into a trust. And also you have to go get SEBI approval, and SEBI scrutinizes the trust deed. They'll ensure that it's in line with the SEBI guidance. So in several cases, what we're doing now, before an IPO, with the number of IPOs that are happening now, prior to the IPO, we are setting up these trusts. Because when you set up the trust prior to the IPO and after listing, there's no question of going to SEBI and getting an approval. That gives you a lot of flexibility in terms of how you want to structure it. You can have professional trustees, you can have multiple layers of trust. It gives you a fair bit of flexibility.
Can a non-Indian citizen create a trust in India?
See, if your assets are in India, okay, technically you can create a trust, right? And there is no restriction in terms of having a PIO or an OCI person set up the trust. And we'll have to obviously look at who the beneficiary pool is and so on. And we'll have to ensure that it's in line with our FEMA regulations.
So one more question from my end, which we face this when we're doing a will for a client, getting a will done. So what happened was there was a clause which said post so and so transfer, the so much quantum of money should go to the unborn child. Okay. So from and what I understood based on the Indian inheritance law is that you can't bequeath something to an unborn child if the
Correct.
lady is not already pregnant. Is that correct? In
Yes,
case of
that's
a
right.
will? So can that
Correct.
be managed through a trust?
So you can manage it through a trust in the sense that you'll define your pool of beneficiaries. So even today, when we set up trust, we say it's not only for the spouse and children, but also future lineal descendants. But when I'm setting up the trust today, I'll also want to have one person who's already there who will be a beneficiary, and then it will be future lineal descendants.
So that can be managed through a
Yes.
trust, but not through a will.
See, the trust, the idea of setting it up is it's also more multi-generational. It's not only for your current and next generation, but also the future generation.
Okay. What's the difference in setting a HUF or trust, especially looking at immovable property?
See, HUF is a very unique concept, like I mentioned, and it was typically for tax reasons, right? But increasingly, we are seeing that HUF has become very archaic. There's also been conversations of whether they want to abolish the concept of HUF itself. So if at all you're looking at having immovable property, consider a trust which achieves a lot more objectives than just the HUF, because with an HUF, it becomes very complicated. You have members, you have co-partners, there is automatic addition of members when someone is born, there is automatic deletion, control, all of that becomes very complicated, which is why increasingly people are saying, let's unwind our HUFs. And particularly in situations where we have US beneficiaries and so on, the HUF is becoming very, very onerous.
We'll take one last question. Any further questions, we can possibly reach out to you and we can help answer those. That is taken care of. Okay. How much distribution can be done to NRI beneficiaries from Indian trust in 1 year? Does LRS limit apply? What are the compliance requirements for trust and NRI beneficiaries?
See, this is a question where we don't really have answers in the regulations. It really depends on your authorized dealer banks, right? So there are certain authorized dealer banks which have taken the view to say that if there is an Indian resident setting up a trust where you have a mix of resident and non-resident beneficiaries, if there is a distribution made to a non-resident beneficiary, it's distributed to the NRO account. From the NRO account, it's essentially 1 million for capital and capital gains, and current income, there is no limit.
Sure. Thanks. Thank you, Akshika, for sharing your insights with such clarity and depth. Thank you all for being a part of today's webinar. Hope it's been helpful.
Thank you so much. I hope this was insightful. Bye-bye.
Definitely. Yeah. To
Bye.
put it metaphorically, an estate plan is like a Google map. I think without it, the family might still reach the destination, but not without wrong turns, heated debates over directions, or even blame the driver. And what could be actually a smooth ride can then actually turn into a road trip story, which no one wants to remember. I would like to leave you with this thought and thank you once again for being a part of this conversation. And may you all carry with you the spirit of initiative to plan your legacy wisely. Thank you.
Thank you so much.